Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within mountains of corporate paperwork. And let me tell you, Bancorp's latest report has a few surprises waiting for us, especially when it comes to money matters. This is a snapshot of Bancorp's financial health as of the 30th of September 2025, and a lot has shifted since the end of last year. Let's dive straight into those numbers. The company's total assets jumped by a solid 10% to reach over $2.6 billion. That growth is mainly fueled by more loans, with commercial real estate loans alone climbing by more than $112 million. And get this, their home mortgage loans also saw a huge surge of over $78 million. But where is all this money coming from? Deposits. Total deposits are up a whopping 12% to nearly $2.3 billion. It looks like folks are trusting Bancorp with their cash, and that is a good sign for a bank. Now let's talk about making money or income. For the third quarter of 2025, Bancorp raked in $6.7 million in net income. That is a healthy 23% jump from the same time last year. For the first 9 months of the year, their net income hit $18.6 million, an increase of 16%. This growth is largely thanks to their net interest income, which is the difference between what they earn on loans and what they pay on deposits. It went up 23% in the third quarter and 18% for the first 9 months. Their net interest margin, a key measure of profitability, also improved, climbing to 3.26% in the third quarter. This means they are earning more on their assets compared to their liabilities, which is great news. They also had some good news in other comprehensive income, which is like a side pot for gains and losses that don't directly impact profit right away. Their available for sale debt securities saw nearly $4.7 million in net changes in the first 9 months of 2025, which is a positive sign for their investment portfolio. Shareholders' equity, which represents the owner's stake in the company, grew by a good 8% to over $221 million. While they did pay out dividends, which is always nice for shareholders, they also saw some stock buybacks, which can sometimes signal confidence from management. Looking at how they generate cash, their operating activities provided over $22 million in the first 9 months of 2025. Investing activities used a lot more cash, over $210 million, mainly because they are putting more money into loans, which makes sense for a bank. Financing activities brought in over $219 million, largely from an increase in customer deposits. Overall, their cash and cash equivalents ended up higher, which means they have more readily available cash. They also mentioned a change impacting their income tax disclosures coming up in 2025 as part of new accounting rules. And here is a big piece of news that happened after the reporting period ended. On the 7th of November 2025, Bancorp raised $25 million by issuing a new subordinated note. This is basically borrowing money that counts as capital for them and will help strengthen their financial position, especially for supporting future growth. Let's check out their investment portfolio. They're available for sale debt. Securities are valued at almost $201 million. While they show some unrealized losses, it is good to see that these are mostly due to interest rate changes, not because the issuers are in trouble. The vast majority of these are investments in US government agencies or sponsored securities, which are generally considered very safe. The heart of any bank's business is its loans, and Bancorp's loan portfolio is growing. Gross loans are up 10% to over $2.15 billion. Commercial real estate loans are a huge part of this, making up 51% of the total. Home mortgages are also a significant chunk at 27%. They've also increased their allowance for credit losses, which is the money set aside for potential loan defaults, to $27.3 million. This shows they are being cautious, especially with the economic outlook. They are keeping a close eye on loans that rely heavily on collateral, like hotels and retail properties, especially for SBA loans. For these, they are keeping a close watch on their value. Looking at how current their loans are, it seems like the majority are still in good standing, but there is a slight increase in loans that are 30 to 89 days past due, which is something to watch. Their premises and equipment, which includes things like buildings and branch technology, saw a moderate increase, which probably reflects investments in their physical locations and infrastructure. Their servicing assets, which are related to managing loans they've already sold, are valued at over $10 million. The good news here is that they are not seeing any impairment on these assets, meaning they expect to collect what they are owed. Bancorp uses Federal Home Loan Bank advances and other borrowing arrangements to fund its operations. They have significant available borrowing capacity, which is a good cushion to have. Their effective income tax rate has gone up a bit, which is mainly due to higher profits and some adjustments in how they calculate taxes. They have commitments for future lending and letters of credit totaling over $342 million. This is normal for a bank, but it means they might need to provide funds in the future. Also, their investments in low-income housing partnerships continue to grow, showing a commitment to community development programs. When it comes to their employees, they have a stock compensation plan. A good portion of their employees have received restricted stock awards, which helps align employee interests with the company's success. The company expects to recognize over $1.5 million in future compensation costs related to these awards. This section really gets into the nitty-gritty of how they value things. For their available for-sale debt securities, they mostly use observable market data to estimate value, but for some harder-to-value assets like certain loans and real estate owned, they use less observable inputs, which requires more judgment and can introduce more uncertainty. It is interesting to see how they value certain assets on a non-recurring basis. For things like collateral-dependent loans and other real estate owned, they rely on appraisals and market data, and for these they're using unobservable inputs. When it comes to the value of the collateral for their real estate loans, for example, they're using capitalization rates, which is a key factor in how they assess potential losses. Bancorp uses derivatives like interest rate swaps to manage risks, particularly those related to interest rate changes. They've designated these as cash flow hedges, meaning any impact on their value is recognized in other comprehensive income, and then later impacts their interest expense. This is a smart way to smooth out earnings. This is crucial for any bank, Bancorp, and especially its bank subsidiary, Open Bank, are clearly meeting and exceeding all their regulatory capital requirements. Their Common Equity Tier 1 capital ratio, which is a key measure of a bank's financial strength, is well above the minimum required levels. This means they are in a strong position to absorb potential losses and are considered well capitalized by regulators. Earnings per share, both basic and diluted, show a nice increase compared to last year. For the third quarter, it is 45 cents per share, and for the first 9 months, it is $1.25. This indicates a growing profitability for shareholders. Here in the management's discussion, they talk about their business, which mostly runs through Open Bank. They highlight their focus on serving small and medium-sized businesses, especially within the Korean American communities. The bank is really leaning into its community ties, and that is reflected in its strategy. They've got branches mainly in California, but also Texas and Nevada, along with loan production offices in several other states. They mentioned the Federal Reserve's recent rate cuts, which is impacting lending and borrowing costs across the board. This is a pretty big deal for banks. And Bancorp notes that predicting future rate moves is tricky with all the political uncertainty. Despite these challenges, they feel they are responding well, thanks to loyal customers and dedicated employees. They really drill down into how their net interest income works. Explaining it is the difference between the interest they earn and what they pay out. They're actively managing this to maximize profits without taking on too much risk. They've increased their provision for credit losses, which is basically setting aside more money for potential loan defaults. This is largely due to loan growth in their commercial real estate and home mortgage portfolios, as well as adjustments in their risk assessments. Their non-interest income, which includes things like service charges and fees from selling loans, saw a slight decrease in the third quarter compared to last year. However, for the first 9 months, it is up mainly due to higher loan servicing fees. This increase in servicing fees is actually a result of lower amortization costs, meaning the value of those servicing rights is lasting longer or being written down slower. Non-interest expenses like salaries and benefits went up across the board. That is driven by staff growth and merit increases. But here is an interesting tidbit. Their data processing and communication costs actually dropped significantly. This is because they switched to a new core banking system, which is apparently more cost effective. They expect these savings to continue, which is great for their efficiency. Their income tax expense has also increased, largely because of higher profits. But there was also a revaluation of deferred tax assets, which had a positive impact. Overall, they believe their future tax assets will be fully realized. The company's investment portfolio is a significant part of their assets. They classify these as available for sale and mark them to fair value. The portfolio is mostly invested in US government-backed securities, which are considered very safe. The loan portfolio, as mentioned, is growing significantly, especially in commercial real estate and home mortgages. They're also keeping a close watch on their loan quality, with a slight increase in non-performing loans, but their allowance for credit losses still seems to cover those potential losses. Their allowance for credit losses has climbed, reflecting the higher loan volumes and a more cautious approach to risk. They are using sophisticated models that factor in economic conditions to estimate potential losses. Non-performing assets, which include loans not generating interest and properties owned after foreclosure, have increased. A notable item here is a decline in the value of their other real estate owned, but a good portion of that is offset by an SBA guarantee, which mitigates some of the loss. Their deposit base is solid and growing, especially their interest-bearing deposits, and they have access to plenty of other funding sources if needed. They are also mindful of their uninsured deposits, which make up about half of their total deposits. Liquidity seems strong. They have ample liquid assets and significant available borrowing capacity from various institutions. Their overall capital ratios are well above regulatory requirements, meaning they are financially sound and well prepared for potential challenges. It is also worth noting that they completed a subordinated debt issuance shortly after the reporting period, which further boost their capital. Regulatory capital requirements are met and exceeded, which is a reassuring sign of stability. They are actively managing interest rate risk, which is a big deal for banks. They use simulation models to understand how different interest rate scenarios could affect their earnings and the value of their equity. While the numbers show some sensitivity to rate changes, their overall position seems to be managed to minimize negative impacts. Their management has evaluated their disclosure controls and procedures, and they believe they are effective in ensuring accurate reporting. The company doesn't seem to be facing any legal issues that are expected to have a material impact on their financial health. Now, let's talk about the risks. They are exposed to cyber threats, which is a huge concern for any company in today's world. They are investing a lot in security, but the threats are always evolving. Another big risk is their geographic concentration, with a heavy focus on the Los Angeles area and the Korean American community. This means any downturn in those specific markets could hit them harder. They also worry about keeping up with technological advancements in banking, which can be expensive and risky. And their reliance on third-party service providers means any problems with them could disrupt operations. They also acknowledge that adverse conditions in Asia could indirectly impact them due to their customer base. And of course, credit risk is always a major factor, with potential challenges if borrowers can't repay loans, especially with interest rates still elevated. Non-performing assets are also a concern, as they can take a long time to resolve and hurt profitability. The models they use to estimate credit losses might not be perfect, and there is always a risk that their allowance for losses might not be enough. They may also need to raise more capital in the future, and that depends on market conditions. Plus, a commitment to donate 10% of their after-tax income to an open stewardship foundation reduces their retained earnings. Competition is fierce too, from big national banks and smaller community banks, as well as newer online players. Their modest size makes it harder to compete, and their marketing focus on a specific demographic leaves them vulnerable if that group faces challenges. Finally, regulatory limits on changing control of bank holding companies can make it harder for them to be acquired. A big part of their loan portfolio is tied to real estate, so any dip in property values could be a problem. And many of their commercial loans carry higher risks than other types, depending on the success of the businesses they're backing. They also flag the risk of government shutdowns delaying SBA loan processing, which impacts their business. They are heavily reliant on their management team, and the loss of key personnel could be a significant blow. They have been executing a leadership transition, and while it seems to be going smoothly, it is always a period of potential uncertainty. Employee misconduct is another risk they highlight, which could lead to legal trouble and damage their reputation. They are aiming for continued growth, but this depends on increasing loans and deposits, which in turn relies on their capital resources. Expanding into new markets could also be a challenge, especially with naming restrictions due to a trademark agreement. They are also aware that opening new branches can bring higher operating costs initially, which could impact profits. They know they might need more capital down the line, and their ability to get it depends on the markets. They also have a commitment to donate 10% of their after-tax net income to their foundation, which impacts their capital building. Competition is a major theme. They face strong rivals and are challenged by new technologies that can disintermediate banks. They acknowledge their modest size makes it harder to compete with larger players who have more resources for marketing and technology, and they are very clear that their focused marketing strategy on specific communities, while a strength, also makes them more vulnerable to downturns affecting those groups. The soundness of other financial institutions can affect them too, as the industry is quite interconnected. They have provisions in their charter documents in California law that could make it harder for a hostile takeover, essentially protecting themselves and their current management. They also note that issuing more stock in the future could dilute existing shareholders' value. Now, what is my take on Bancorp's report? They're showing solid growth in loans and deposits, which is the lifeblood of a bank. Their profitability is improving thanks to a better net interest margin, and their capital position is strong, meaning they can weather potential storms. The increase in their allowance for credit losses, while indicating caution, shows they are proactively managing risks. However, their heavy concentration in commercial real estate loans and within specific communities does present a notable risk, especially if those markets face a downturn. The evolving interest rate environment and the constant battle against cyber threats are also challenges they are actively addressing. Overall, Bancorp seems to be navigating a complex financial landscape with a clear focus on community relationships and prudent risk management, but they need to keep a very close eye on those concentration risks and the cybersecurity front. What do you think about Bancorp's financial performance and their risk factors? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, see you next time.